Yield curve risk. It is the risk of experiencing an adverse shift in market interest rates associated with investing in a fixed income instrument. When market yields change, this will impact the price of a fixed income instrument. The yield curve is a graphical illustration of the relationship between interest rates and bond yields of various maturities. Yield curve risk is the risk that change in interest rates will impact price of fixed income securities. Changes in the yield curve are based on bond risk premiums and expectations of future interest rates. Interest rates and bond prices have an inverse relationship in which prices decrease when interest rates increase, and vice versa. Flattening yield curve. When interest rates converge, the yield curve flattens. A flattening yield curve is defined as the narrowing of the yield spread between long and short-term interest rates. When this happens, the price of the bond will change accordingly. Steepening yield curve. If the yield curve steepens, this means that the spread between long and short-term interest rates widens. In other words, the yields on long-term bonds are rising faster than yields on short-term bonds. Or short-term bond yields are falling as long-term bond yields are rising. Therefore, long-term bond prices will decrease relative to short-term bonds. Inverted yield curve. On rare occasions, the yield on short-term bonds is higher than the yield on long-term bonds. When this happens, the curve becomes inverted. An inverted yield curve indicates that investors will tolerate low rates if they believe rates are going to fall even lower later on. So, investors expect lower inflation rates and interest rates in the future.